Hi everyone, welcome back to my channel in the money options trading and education, and welcome to the fourth video. I really hope you're enjoying the content on this channel. If you're enjoying these videos, please subscribe to the channel and please like my videos. Also, comments are appreciated so I can learn how to best serve you. For this educational video, I will discuss writing covered calls. This strategy is one of the easiest ways to generate passive income as an options trader. A quick recap from 2 videos ago. A call option gives the buyer the right, but not the obligation, to buy 100 shares of an underlying asset at a predefined strike price and expiration date. For this option, the buyer pays a premium, which is reflected in the price of the option. The seller of a call option receives the premium and, in exchange, is required to sell 100 shares of the underlying asset to the buyer if the buyer chooses to exercise the option early in the case of American options, or if the underlying asset expires at a price above the strike price in the case of European options. We'll discuss the different flavors of options in more detail in a later video, but in general, you should assume we're dealing with American options when discussing options theory. Selling a call option by itself, also known as selling a naked call, can be extremely risky. Theoretically, the underlying asset can increase without limit and we could be forced to sell the underlying asset at an extremely high price. With selling naked calls, there is the potential for a margin call or even a full liquidation of our trading account. However, there is a way to sell call options that is far safer, disciplined, and repeatable that allows us to yield a passive income. Suppose we own 100 shares of the underlying asset at some break-even price. We then sell a call option against the same underlying asset at a strike price above the break-even price, which is the average cost of the stock. There are other flavors of covered calls that use strike prices that are at the money or in the money, but we'll save that for a later video. Here, we focus on writing out of the money covered calls. So, how is this different from selling a naked call? Let's consider each possible scenario. If the stock price rises above the strike price and the option is exercised by the option buyer, then we are already holding the underlying shares and we can deliver them to the option buyer at expiration. We no longer have to worry about the unlimited losses that might have occurred through selling a naked call. Next, consider if the stock price closes below the strike price at expiration. In that case, the short call option expires worthless, and we can sell new call options that will bring in more premium income. This is similar to renting out a property and collecting monthly rent. However, if the real estate value goes above a certain level, we lose the rights to the property. Let's illustrate with an example. Suppose we've done our due diligence using fundamental and technical analysis, and we've concluded that Amazon is a perfect candidate for selling covered calls. Amazon stock is currently trading at $93.80 per share. We know that earnings will come out on February 2nd, and this should generate a lot of shareholder interest. The volatility will be elevated until after the earnings announcement, after which the volatility will get crushed. In my examples, I use the Interactive Brokers platform, but any broker that has options will have a similar layout. I want to now look at the option chain to find an appropriate strike price for my covered call strategy. Please note that in the time it took to take a snapshot of the option chain, the price of Amazon stock moved from $93.80 to $93.82. This is common around the opening hours of trading, but it is not a huge issue when we're taking covered calls. The stock price moves around faster than the options price, which is a key concept that we'll talk much more about later on in a future video. We are now looking at the February 3rd options chain, which is one day after the earnings announcement. The nearest out of the money strike price is $94. Suppose we are extremely bullish on Amazon and we think that earnings will result in the stock price going up to $96 or higher. We want to participate in the price appreciation of Amazon between its current level of $93.82 and $96, which is a profit of $2.18 per share or $218 if we're buying 100 shares. On top of that, We will also collect a premium of $3.54 per share or $354 per contract by selling a call option. That yields a return of $572 per covered call, and it only cost $9,283 to set up the trade. That is a return of 6.16% in only 8 trading days. Suppose we're interested in making money from the covered call, but we have no intention to hold Amazon stock long term. In that case, the rise above our $96 strike price is the best scenario, and we are happy that the trade will close at the end of the trading day on February 3rd. There are other scenarios that could also happen. Suppose we want to collect premium income, but we don't want Amazon stock to get called away from us. In that case, we're happy for the stock price to close below $96, but we probably don't want Amazon to sell off too much. Otherwise, we will not collect much income the next time we sell call options on Amazon. Lastly, we have the bearish case, which we definitely don't enjoy. In this case, Amazon sells off significantly due to earnings. While we will be upset that Amazon shares are worth much less than our break-even price, we will be better off having sold the call options. When we try to sell call options again, we will have to choose a longer maturity in order to capture more premium. This will tie up our capital in Amazon for longer than we initially expected. However, during that time, we will collect dividends. This is why I always recommend doing covered calls on blue-chip stocks that are represented in the S&P 500. If I get stuck holding the shares, I want it to be in a stock that I love and don't mind holding for the medium term. Some of the worst performing trades in the beginning end up being the biggest winners, and I'll have more to say about that in later videos. The last graphic in today's video shows what the order looks like when you take a covered call. Here, you'll notice that the cost for the overall trade is $90.36, which reflects the ask price of the stock at $93.81 minus the bid price of the call option, which is $3.45. Therefore, we can imagine that the call option reduces the break-even price of the Amazon stock down to $90.36. This is what we mean when we say that covered calls improve the cost basis. The max return in the performance profile says $555, which is slightly different than the number I quoted above of $572. This is due to commissions and the assumption by interactive brokers that we fill the trade at the most disadvantageous spreads. We'll have much more to say about that later on. If you enjoyed this content, please subscribe and leave a comment for how we can improve these videos.